everyone. Thank you so much for joining. What a momentous week for markets. I mean, everything that we thought financial markets would do in the next year has essentially been upended in 1 week. Everything from rate cut expectations to equity market trends to where bond yields are going, where bonds are going, and of course energy as well. So let's dive straight into the charts because there is so much to talk about. And of course we've got payrolls. Let me keep an eye on the clock so I don't forget about them. Looking first, obviously my typical, this is the World Equity Market Index. It's just so useful to see where things are. And as you can see, a lot of negativity in markets, not so much in Asia though. That is really, really interesting. And I think a little bit misplaced because they are massive, Asia, China, Japan, they are massive energy importers as well. So just a bit of a less risk-off tone in that session, whereas very much the focus is on Europe and also the US. But if we look at the weekly performance of stocks, as you can see, Asian stocks have sold off. Again, I'm really at a loss to explain why Chinese stocks sold off as much, because in my view China is actually weakened by this conflict because of their reliance on oil, particularly from Iran, also on Venezuela. So this just makes their economy a lot more expensive to service. But take a look at this, a 6.5% drop in the Euro stocks for this week, 5% drop for the FTSE, CAC down 6.7, DAX down 6 as well. Europe, US stocks are outperforming. When we look at a currency adjusted basis as well, because we've seen the dollar gain so much attention this week because it's so liquid, it's proven itself to be the best source of safety, the best safe haven in this current environment. Look, on a dollar, we've seen the dollar surge, so euro's fallen, so's the pound. So we've actually seen on a currency adjusted basis, which is what kind of really matters for a lot of people if they're not living in the US and not living and earning and stuff in dollars, then it's actually down 8.5% for the Euro stocks, down 6% for the FTSE 100. So totally wiped out those gains that we saw for the FTSE 100 in February. Much lower losses this week, as I said, for the US, because the US is seen to be a lot more resilient to what's been going on. But I think what's been really interesting is that we've seen a very strange divergence between stocks and equities. Yes, stocks have sold off, and they have sold off, and this is quite a hefty loss. But if we just go to have a quick look at what bond markets are doing, that really is, that is quite something. So look, a 10 basis point increase in the 10-year yield for the UK today, 4 basis points for France, 1 basis point for Germany. Again, we're up as well in the United States and Canada. There's a lot wrong with the UK bond market this week. Let's just take a look. Look, a 26% gain in the 10-year yield. It's very similar in the 2-year as well. So 30 basis point increase in the 2-year yield. It increases across the curve. Now, why is the UK underperforming? Remember, when prices fall, yields rise. And why is it underperforming compared to everywhere else? Well, that is largely because our economy was weak going into this anyway, and an oil price spike is just going to potentially push us into recession at the same time as we're facing stagflation because energy prices will spike. And the way that our energy market is priced with the energy price cap, we won't actually see this feeding through until July, but it will feed through, and then that will keep another burst of inflation. So really it's about pricing out of rate cuts. And just before I came on, I took a look at that. There's now only a 50% chance of 1 cut from the Bank of England this year. And get this, we have seen 25 basis point increase in French and German yields as well, because there is now 1 rate hike expected from the ECB. So all change there, and that is very much playing out in markets. But one thing that's interesting is we're actually seeing bond yields outperform equities, and if equity traders start to align with bond traders, then that could spell trouble for stocks. And one thing I have received, just a couple of messages about, I know some of you have been concerned about it. Why haven't actually we seen a bigger reaction to this? Now, we're going to look at oil prices and everything afterwards, but I do just want to, we've got 30 seconds now before the payrolls. 55k is what is expected. Unemployment rate is expected to remain steady at 4.3%. We've also got retail sales coming out, and essentially we're looking at the control group of a nice 0.3% gain for January. February payrolls, though, obviously totally overshadowed by what's going on. We do expect the market reaction to be quite minimal, but it is fundamentals because markets have been so focused on politics this week. If we get a hit or a miss, that will play out in markets, and we're just waiting. We're 5 seconds away now. Lead indicators have been quite strong, so there's a slight bias to the upside, but we will have to see. Here we go. Okay. Oh, no bias to the upside at all. A drop of 92,000. for February. Now, could that be weather related? But it seems all in very, very strange. 86% decline in private sector payrolls, manufacturing payrolls down as well. A net revision lower of 70,000 for the last 2 months. And the unemployment rate rises actually to 4.4%. So this suggests to me that there was some upward bias in the January data, and that's now been worked out. There was also some more winter storms as well in February, but we'll have to watch that. Stronger than expected hourly earnings as well. So very difficult to read. Let's take a quick look at the retail sales. Retail sales came roughly in line with expectations, with the control groups, that's kind of like the core sales, rising by 0.3%. So let's just take a quick look at what this means for equities. We'll have to take a quick look at futures. I'm going to take a look as well at the dollar. Let's see, that's where it's going to play out first, right? It will also, payrolls are incredibly sensitive to, oh look, too many tabs, sorry. I'll have to close one of those. But as you can see, what are we doing? The market doesn't know what it's doing. It's holding very steady at the moment. Okay, while we're doing that, we're going to take a quick look at the 2-year yield. Oh yeah, okay, so it is down, it is lower. So people are looking at rise in the unemployment rate. That seems to be working into the bond market, and also that decline in payrolls. So that increases the chance of the Fed taking action. It goes back to the old narrative that we had kind of January and before the January payrolls report, which came out obviously a month ago. Before that was that the US labor market is really weakening, and that's very much playing out here. So that should be dollar negative slightly, but we are just holding off here. Remember, there's two forces. Sorry, excuse me. There's two forces working on the dollar at the moment. One is this much weaker payrolls report, and then the other one is this geopolitical pressure with the dollar acting as a safe haven. So it's a balance, and it's very much not moving very much at all, because both buyers and sellers are going at the dollar together. Now let's just take a quick look at where we are with the energy space, and we'll go back to US. How US have moved. Now, as we move up to the US open, we're seeing a big rally again in the oil price. So the oil price is up 6% WTI crude, because obviously that's going to be in huge demand if we can't get crude and other oil out of the Middle East. Brent crude is up 4%. So 88, just under $89 a barrel now for Brent, and again, just under $86 for WTI. So these are the highest levels for quite some time, since 2024. So something to watch out for. This is in itself is inflationary. Lots of concern about supply disruption. Qatar has come out and said it's going to, even now, even if the war ended now, there'd still be weeks or months of disruption to natural gas. Natural gas is having a much more moderate increase of 2.6% today, a 62% increase for the week though. My goodness, a 22% increase in Brent crude, 28% increase in WTI crude. This has totally changed the whole energy space. Look at that, 30% increase in gasoline, and heating oil 37% as well. So, you know, very big moves, incredibly big moves. We've seen jet fuel absolutely surge, and that's having a massive impact on This is having a massive impact on airlines. Now, this is airlines, Bloomberg's airline index, so both small and large airlines worldwide. And this is the percentage change in the last week. As you can see, if you look at the right-hand side of this chart, a massive drop in airlines, so down like 11%. This is the biggest drop since 2022, March 2022, when Russia invaded Ukraine. So that increase, firstly, flights are essentially grounded, more or less, in the Middle East. Lots of flight cancellations as well. And that's probably going to persist for some time, definitely, I would say, till the end of the month. In terms of tourism going back to the Middle East, that's going to be much harder to pick up. So that kind of commercial traveller may not, that will take a very long time for the likes of Emirates, of Qatar, of BA even, to be able to travel that way. And it's a very, very important hub. Doha is, and so is Dubai. So global travel is completely impacted by this. And it's also, of course, the increase in jet fuel. And that's what caused that massive decline in airlines back in 2022. Oh, apologies, guys. And let's take a look at, again, at these equity markets just to see what they're doing. Yeah, there's a little bit of an easing in the sell-off, actually, probably because Fed expectations are going to move a bit higher. Let's take a look at that dollar index again. It hasn't really moved Let's take a look at the 2-year bond yield. It's down a little bit, but it's still higher, so it's reversed course. Not seeing any let up though in that increase for the pound, for UK yields, for European yields. They're all moving higher. The UK yields in particular are really taking a battering. As I said, it's their fears about recession, it's fears about inflation. That is stagflation. That's terrible for lots of things. But because bonds have sold off much more sharply than equities so far, will equities play catch up? Well, we'll have to see. We saw as well FTSE 100, as I mentioned there, FTSE 100 has been a little bit marginally more resilient than elsewhere, but let's just dig in to see, well, what's gone up, what's gone down. Not very much has actually gone up, but the top 10 performers so far this week have been BP. You've also got Admiral Group, which is an insurance company. You've got BAE Systems, obviously, that is a defense firm, of course, very, very good. And we've also got Shell, which is up very small. Now, they've had quite small increases, BP and Shell, considering what the oil price has done, that the oil price has risen by 22%. But actually, having that blockage in the Strait of Hormuz isn't actually very good for oil companies. And that's what that's telling us. If we look on the downside for the UK equities, look at that. Miners have gone down. We've got house builders are going down, and that's because bond yields are moving up, and we've had a massive recalibration higher in mortgage rates as well in the UK. So that just makes it less likely that the Barretts of the world, the Persimmons, will be able to sell the houses that are making it hard to get a mortgage. EasyJet, obviously one of the biggest decliners, down 11%. International Consolidated Airline Group, that's the parent company of BA, of Iberia, hit very, very hard, down 13% in just 1 week. And then very strangely, Reckitt Benckiser also down 14%. It is a consumer staples company. You would think that it's very good. However, it's a very global company that does operate in the Middle East as well. So all the disruption in the Middle East disrupts its supply chains, makes it very hard to sell into the region. So we're going to see a broad impact if this conflict really goes on. Now, we had seen mediation, hopes that there would be mediation. Iran said mediation was ongoing with other members, so a kind of Gulf states. It doesn't know what that actually means, and we need to get some confirmation from the US and probably from the Israelis as well that they are willing to end this war. And actually everything that the US in particular have been saying sounds very, very hawkish, that the war will carry on. I think events over the weekend are going to be absolutely critical for financial markets. I do think that this weakness in the payrolls data, if we just go into it, we can maybe take a little bit, just see a little bit more of what was driving that decrease, that sharp, unexpected drop in payrolls. Let's just go into the data. Just bear with me for 1 second. So we've seen some quite broad-based declines, actually. Declines in education and health service. I mean, that's been such a strong gainer of jobs. Declines in professional and business services, leisure and hospitality as well. Now, that could be linked to weather. This report, to me, isn't necessarily ringing true. I think it could be down to maybe a bit of a recalibration after that big increase last month. Maybe that was just a bit out of sync. Also, we've had that weather-related disruption. Obviously, the construction job losses, -11, it's not actually that much. Leisure and hospitality, though, quite a big, sharp decline. So really, this payrolls report is going against what we're seeing elsewhere. We were seeing kind of green shoots for the labour market. We had a better than expected ADP private sector payrolls report. We had stronger private sector jobs, both in the manufacturing and services sector. So the employment components of both those indices were stronger. Government jobs, they're down about just kind of marginally, down 6,000, certainly not helping situations. But I think it is very, I don't know, we need to kind of see if there's any caveat to what this, oil and gas extraction payrolls, they actually rose. Well, that will be kind of good when you see what's going on in the rest of the world. I'm just looking. Yeah, so we've seen a mild paring back of some of the losses in Europe. Let's just take another look at that dollar index before we go. Again, it's not really moving. And then, of course, we do also want to take a look at what the bond markets are doing. Yeah, that increase in yield, that fall back in US 2-year treasuries. So an increase in 2-year treasury prices because yields move inversely to price. That's pretty stable, so it's down quite a bit. Let's take a quick look at what the Fed is doing. That's the United Kingdom. Oh my goodness, yeah. So we were expecting just a week ago an 80% chance of a rate cut from the Bank of England on the 19th of March, and that's dropped down to 13%. We could see that increase a little bit, but if we just look overall, we're still pricing out the chance. Yeah, there's a very low chance of a rate cut this year from the Bank of England, which is incredibly disappointing considering where we were earlier in the year. In the US, not seeing too much of a difference, still not expecting that rate cut until the back end of the year. So around about July is when it is expected. And for 2026 as a whole, looking for about 1.5 rate cuts. That have been over 2.5 rate cuts again quite recently. So this whole situation is the Middle East situation, the geopolitical situation is having a really big impact on markets. And then you've got the non-farm payrolls kind of having a bit of an ameliorating effect, if you like, but I don't see it as being really lasting. I mean, what will be much more lasting for the weekend is if we hear, or for markets generally, as we move into next week, is if we were to hear something over the weekend, like there's mediation going on, like they're going to halt fire. I think that would be really, really critical. And the most critical thing is that they open the Straits of Hormuz. We know that the market, this whole increase in the oil price this week, the 22% increase, that is because we know that there's going to be disruption because oil facilities have been hit across the Gulf. But if it goes on and on and on, then, you know, I really see us getting to 100 and above in oil. That would be incredibly damaging. Oil price spikes are so damaging for markets. The other thing I just wanted to show you, gold has actually turned a bit more positive, just as we've seen yields drop off a little bit. Gold has not been gold and silver, precious metals have not been a reliable safe haven in this crisis. Gold is down 3% on the week, 11% for silver, hence the decline. Some of the worst decliners in the week actually on the FTSE 100 are those mining companies. Now, partly that's also because they've been the best performers over the last kind of year. And so it's a bit of rotation into maybe some of the energy stocks, maybe into oil, physical oil. So stock traders are moving and they are doing things, but traders definitely trimming their risk into the weekend. And that these effects of higher energy prices are absolutely playing out in the rate space and in equities and bonds. So guys, thank you so much for joining. A surprise payrolls report. We could see a bit of dollar weakness. We're certainly seeing a bit of a recovery in the treasury market on the back of this. And we will, of course, watch what the markets do when they open at 2:30 in the US. Thanks so much.